Live stream where I'm breaking down the value of a business for an entrepreneur that is looking to acquire a business that is in the accommodation slash food services sector. And this was an interesting one that was sent to me because, as you will see, there's a couple of disconnects in the information that was provided, but not surprisingly, because many entrepreneurs aren't really sure what they're looking for when they are looking to buy a business and when they're reviewing the financial statements of one. So I'm going to go ahead. I'm going to give you a little peek here at an entrepreneur that went to emilynow.com, got a free business valuation done, probably because they're just trying to check out whether or not this business is worth it. And they ended up sending those results over to me, which you can do as well. Send me a DM. Be happy to give you some unlock codes if you're looking to kind of check your value over and over again. So let's go ahead. Let's get this math in here for this particular individual. So go to emilynow.com. That's MLENOW.com. You can connect directly to QuickBooks if you just want to pull all of your data in and have the math generate for you automatically. But if you don't have QuickBooks, then you can go ahead and just do a manual calculation with a few key pieces of information. So let's go ahead and fill this out. So this particular person is buying a business. They are in the accommodation and food services marketplace. And this is where it gets interesting. So when they sent the information over, they said there was about $50,000 worth of assets, but there were no liabilities and no equity. Now, that in and of itself isn't a problem, except that the very basic math for a balance sheet is your assets less your liabilities equal your equity. What does your business own? Assets. What does your business owe? Liabilities. Whatever is left, that's your equity. So in this particular case, this entrepreneur either didn't have that information or didn't bother putting it in. So I can only do kind of a bit of evaluation here. Okay, then when it comes to the profit and loss, they said that, let's see, the business is doing about $392,000 worth of income. They had cost of goods for about $209,000. The gross profit's about $180,000. So that again represents the money left over to pay the costs of the business. Costs of the business are about $198,000, which means they're running a loss, or this particular business is running a loss. I shouldn't say their business because it's very obvious. They're just looking to buy this business. So this might have been the information that they received. As you can see, this business is worth nothing. Now I'm just gonna pause here for a minute. The reason the business wouldn't be worth anything just based on the math is because there's no equity in the business. Remember, they only said they had $50,000 worth of assets, but they didn't have, they had zero liabilities and zero equity. So that doesn't make any sense. So somewhere the math is not right there. But because the equity is zero, then you go through their profit and loss statement, the revenue and their expenses, and they're running the business at a loss. So between no money coming out of the business, no profit, and no equity, this business is worth nothing. Well, let's take a look and let's see if we can't figure out what this business should be worth, assuming that everything was okay, assuming they were doing the things they needed to do. So I'm gonna go ahead, I'm gonna get an access code. And again, if you DM me and you use emilynow.com and you'd like an access code, I'd be happy to give one to you so that you can keep checking out the value of your business. Let's see what happens here. Okay, this is interesting. So business is worth nothing, but all things being equal, if the business had a correct balance sheet and it was producing some profit, it would be worth about $185,000. So in this case, this business is off the mark by about $185,000, which is, which is too bad. Let's see if we can't break down and figure out why that's the case. Let's just see here. Okay, let's go through. So debt to equity, again, if you've watched a couple of these valuations, you'll know that there are, in essence, three things that make up the value of the average business. It's, or the three kind of signals that an entrepreneur wants to look for. There's a whole bunch of them, but basically there are three signals. The first one is how much debt does a business have compared to the equity, right? So do creditors own more of a business than the business owner owns of a business? Secondly is the gross margin. After paying for the costs associated with getting revenue, how much money is left over to pay for the costs of the business? So the simplest example is if you've got a manufacturing business, in order to sell the widget that your business manufactures. You have materials and costs that are required to be paid in order to produce that widget to sell. So once you've got the widget, you've paid for the stuff, you've got some money left over, it's called your gross margin. That money has to be able to pay for the rest of the expenses of your business. And if you've done the math well and run a good business, there should be some profit at the end of the day. So how much debt versus equity? How much money does a business have to pay for its expenses? And then after it's paid for all of its expenses, how profitable is it? So let's go ahead and break into this business and see if we can't figure that out. Okay, so there's no point talking about the debt to equity because in this case, the business apparently has no debt. It also has no equity. And so in order to make this math work, the business is going to have to show that they've got at least $10,000 worth of equity, even if they kept their liabilities at zero. So that's a really important point to note. The gross margin for this business is 46%, which is low compared to industry benchmarks. And you might be thinking, well, first of all, what are the industry benchmarks? At emilynow.com, we use the North American Industry Classification System, which is basically a database of all of the businesses in North America ranked according to the sector that they're in. And financial institutions will use this database to make credit decisions, financing decisions, et cetera, et cetera. So it's a base of information that serves well as a guidepost for an entrepreneur to understand where does their business fit in. So if they're in this case, they're in the food business, all food businesses generally look and feel the same. They have the same math, and on an average, the math will set a benchmark. And so that's what's being compared to here. So this business, it looks like if it was generating, let's see here, about almost $400,000 worth of revenue, their cost of goods at $209,000 is about $67,000 too high. So we've got to figure out a way to bring down their cost of goods. And if it's a food business, that would look like the cost of food. So in a simplistic way, if they make, if this particular business makes sandwiches and they sell sandwiches, there's the cost of the bread, there's the cost of the lettuce and the cheese and the meat and whatever else goes on the sandwich. So what this valuation is telling us is that the cost of those inputs or the cost of those materials to produce the sandwich is higher than it should be by about $70,000 if the business is generating $400,000 worth of income. As we move on to the profit end of the equation, it looks like, which we already knew, because this business is generating no profit, it's got to be able to produce some profit. And in this case, it looks like if the business was able to reduce its expenses by about $48,000, so that means right now it's running about $198,000. So if it was able to reduce its expenses by about $48,000, that would give this business another 30 grand worth of profit. That would be a meaningful business, which is almost a little under 10% net profit margin, which is great. So in this case, what's kind of my critique? I would say if this business is being purchased, first of all, we can see here that on the balance sheet, which again is a summary of what does a business own, those are called assets. What does a business owe, those are called liabilities. And what's left is the equity. And again, we should all know, equity is basically the accumulation of profit since the day the business was started. In this case, the business is running a negative profit, so chances are pretty good that the equity in this business is negative. Hence, it's probably why it's up for sale. But the other thing that stands out to me, and there's a trend that develops when you look at as many of these as I have, and if you've listened to some of these business valuations, you're going to see the same thing. They simply have too high expenses. So not only is the lettuce and the cheese and the bread costing them more, in terms, maybe that could be an inflationary thing, what have you, they're also running the business at a loss. So their expenses are too high. So that could be, someone's expenses are too high. Usually that means that things like rent, the payroll for their staff, for their employees, maybe the cost of the owner, maybe the owner is on payroll and they're taking out more money than the business actually has to give. And so what that tells me is because the business said it had no liabilities, but it's showing a loss on its profit and loss statement, the loss has to be covered somehow. Normally that gets covered by money in the bank. So if you had $1,000 in the bank and then you ran your business at a loss, you would have less money in the bank. But if you had no money in the bank, then where does that loss show up? Well, if you said creditors, you're right. What it means is a business like this is probably not paying its creditors. So if it's supposed to pay its creditors or its suppliers or its vendors every 30 days, chances are they've now either not paid them or not paid some of them, or they have decided to not pay them for 60 or 90 days. So I can already tell in this business that their liabilities are something, and that those liabilities are there because the business isn't generating enough profit to be able to pay for those liabilities. So if I was buying this business, first of all, today it's not worth anything, nothing at all, because no equity and there's negative profit. However, if this business was run well, this business could be worth about $185,000. And so you say to yourself, okay, well, maybe there's an opportunity in this particular business that I could just go in, take over the problems for the current business owner and just alleviate all of the headache in their life by making the decision to run it for them. Maybe you have some other businesses, maybe you own some other food businesses, and this business has a good location, maybe it has a good base of customers, maybe there's something there, but there's no point paying for anything because the truth is there's no value that you're purchasing. In fact, it's running at a loss. We already know it has liabilities if we just do kind of some basic, some basic analysis. And so for an entrepreneur, this would be a great business. It'd be a great business to say, look, just give me the keys. Kind of like in real estate. You know when someone can't make their mortgage payments anymore, so they own a home, can't make their mortgage payments anymore, but maybe they put $10,000 or $20,000 down on a home, or 10 or 20%, whatever the math is. There's some equity there, but because they can't make their payments, they might be at risk for losing everything. Not only their equity, but they might also get the bank calling them saying, "Hey, it's time for you to pay up on this mortgage." So businesses are no different. An entrepreneur invested their time and their energy into putting this business together. It's not worth anything right now. It could be worth $185,000 if someone could pull this thing together, get the expenses in line, bring down the cost of bread, cheese, lettuce, tomatoes, and then work with the vendors who for sure are owed money and work out terms with them to say, maybe we can pay you over the next 12 months. You could pick up a nice little business for kind of nothing. So that's it. My goal is really just to try and do a quick business valuation for entrepreneurs that are running small, medium-sized businesses, whether they're buying a business, selling a business, operating a business, or for any other reason. Maybe they're thinking of investing in a business that they're not going to run. My job is to try and make this stuff a little bit easier because the failure rate for entrepreneurs is really high. Within 5 years, most entrepreneurs will fail. I personally believe they don't have to. The reason they fail is because they don't understand some of the things that we talked about here today. And if they did know some of these things, I think they would make different decisions. Entrepreneurs are incredibly inventive people, and they will problem solve and they'll find their way out of a corner. But my experience over a couple of decades tells me that they don't even know they're in a corner until it's too late, and then they don't know how to get out of it. I get up every day to try and help them do that. So if you're an entrepreneur, go check out MLENOW.com, do your own valuation, figure out what your business is worth, what it could be worth, and send me a DM. Let me know if you want me to do a review on your business. All the information is anonymous anyway. And so I'm just talking about the math that I'm seeing and drawing some conclusions and trying to come up with maybe some strategies or suggestions on how to do things better. So send me a DM, be happy to help you out. You can subscribe, hit the notification bell because I only do these live streams on YouTube. And hopefully you found this helpful. So we will see you on the next live stream.